Hello everyone. I'm so glad you're here. In today's lesson, we're going to discuss adjusting entries, a crucial step in the accounting cycle that ensures our financial statements are both accurate and complete. But before we dive in, let's briefly review the foundation that adjusting entries are built on, accrual accounting. As you may recall from our previous video, accrual accounting means recognizing revenue when it's earned and expenses when they are incurred, not necessarily when cash changes hands. For example, imagine a company delivers a service today but won't receive payment until next month. Under accrual accounting, we still record that revenue now because it has been earned. Likewise, if the company receives supplies today but plans to pay for them later, the expense must still be recorded now since it already occurred. This is where adjusting entries come in. They help bring the records in line with the actual activities of the business. Whether it's recognizing unpaid salaries, recording earned but unbilled revenue, or updating depreciation. Adjusting entries ensure that everything is captured in the right accounting period. In this tutorial, we'll walk through the types of adjusting entries, share examples, and show how they help maintain the integrity of financial reporting. When a company records an expense or income in advance, for example when it pays for a full-year insurance upfront, it's initially recorded as an asset like prepaid insurance. However, by the end of the accounting period, we must adjust the books to reflect only the portion of the expense that actually applies to that period. This means we reclassify part of the prepaid amount from the balance sheet to the income statement. In simple terms, we transfer the expense from an asset account to an actual expense account, such as insurance expense, to match it with the period it relates to. Now, let's look at a scenario to see how this works in practice. Let's analyze this scenario. On May 1st, the company paid $1,800 for a one-year insurance policy in advance. Our task is to record the initial payment, prepare the necessary adjusting entry at month end, and determine how these amounts will be presented in the financial statements as of May 31st. Let's begin with the payment on May 1st. Since the insurance coverage extends over 12 months, the entire $1,800 does not qualify as an expense immediately. Instead, it represents a prepaid expense, which is an asset, because the company will receive future economic benefits from this policy. On May 1st, the correct journal entry is to debit prepaid insurance for $1,800 and credit cash for the same amount. By May 31st, 1 month of coverage has expired. According to the matching principle, we need to recognize the portion of the insurance cost that relates to May as an expense. Since 1 month is 1/12 of the annual premium, we calculate it as $1,800 divided by 12, which equals $150. This amount should now be transferred from the asset account to the expense account. Therefore, the adjusting entry on May 31st is debit insurance expense for $150 and credit prepaid insurance for the same amount. In the financial statements, the May income statement will report $150 under insurance expense, reflecting the portion consumed during the month. The balance sheet will report $1,650 under current assets as prepaid insurance, which represents the unexpired portion of the policy covering the next 12 months. This approach ensures compliance with accrual accounting by accurately matching expenses to the period they relate to and presenting a fair view of the company's financial position at the reporting date. Now, let's look at another example, this time involving prepaid taxes. We'll see how the same principles apply when a business pays for a service or obligation covering multiple months in advance. Let's evaluate the second scenario. On May 1st, the company pays $900 for property taxes that covers a 3-month period from May through July. Before we record this payment, let's consider how the cost will be allocated. Since the payment covers 3 months, we divide the total amount by 3 to determine the monthly expense. This means that each month $300 of the payments will be recognized as an expense, while the remainder will be recorded as a prepaid asset. Given that the payment provides a benefit beyond May, we do not recognize the full $900 as an expense immediately. Under accrual accounting, the payment is first recorded as an asset, specifically as prepaid property taxes. Therefore, on May 1st, we will debit prepaid property taxes for $900 and credit cash for the same amount. By the end of the month, we apply the matching principle. 1 month of coverage has expired, which amounts to $300. Accordingly, on May 31st, we will debit property tax expense for $300 and credit prepaid property taxes for the same amount. As a result, the income statement for May will report $300 in property tax expense, while the balance sheet will reflect $600 as a current asset, representing the benefit that remains for June and July. So far, we have examined how prepaid taxes are recorded and adjusted over time. The same principles apply to other prepaid expenses. In this next scenario, we will explore prepaid rent and see how the journal entries are adjusted when rent is paid in advance for several months. Let's prepare to dive in and understand how companies gradually recognize rent expenses over the coverage period. Let's walk through this example. On July 1st, the business pays $2,400 for rent covering 4 months. Now, because this payment relates to future periods, we do not treat it as an expense immediately. Instead, we record it as an asset called prepaid rent. So the entry is simple. We debit prepaid rent for $2,400 and credit cash for the same amount. As July comes to an end, 1 month of that rent has now been used. That portion should no longer sit as an asset. It becomes an expense. So we adjust the books, debit rent expense for $600 and credit prepaid rent for the same amount. After posting this adjustment, the prepaid rent account shows a balance of $1,800, and that balance represents the remaining 3 months, August, September, and October. That will be expensed as time goes by. In the previous example, we discussed prepaid rent. Now let's take a closer look at prepaid interest. When a company borrows money, the bank may sometimes deduct the interest in advance. From the company's perspective, this deducted interest isn't considered an expense yet. Instead, it's classified as an asset known as prepaid interest. This amount will be allocated over the duration of the loan. Let's explore how this process works. Let's consider a scenario where a company needs a loan of $6,000. However, there is an important detail. The bank deducts the interest upfront. This means that the company doesn't receive the full $6,000 in cash. Instead, a portion of it is set aside as prepaid interest, an asset, since it represents a benefit that has already been paid for but not yet utilized. On November 1st, the company calculates the interest for the next 3 months at an annual rate of 12%. This results in $180, which is prepaid interest. So how much cash does the company actually receive? We take the $6,000 loan and subtract $180 in interest, leaving us with $5,820 in hand. So the journal entry reflects this situation. We debit cash for $5,820, the actual amount received. Then we debit prepaid interest for $180, as this represents an asset that will be consumed in the coming months. And finally, we credit notes payable for the full $6,000, since that is the total obligation to the bank. Moving forward to the end of November, 1 month has passed, meaning 1/3 of the prepaid interest has expired. To account for this, we divide $180 by 3 months, which gives us $60. We then adjust the books. We debit interest expense for $60, reflecting the cost of borrowing for November, and we credit prepaid interest for the same amount, reducing the asset as it has now been consumed. In summary, prepaid interest operates similarly to a subscription paid in advance. You pay the money upfront and the benefit unfolds gradually over time, transitioning from an asset to an expense. Let's look at a new scenario. Imagine it's July 1st and Bright Future Tech decides to stock up on supplies for the new quarter. They purchased $600 worth of supplies, and since there were none on hand before, so we record this as an asset, debit supplies for $600 and credit cash for the same amount. Now at the end of July, we count what's left and find $400 still unused. That means $200 of supplies have been consumed. To reflect this, we debit supplies expense $200 and credit supplies for the same amount. So after adjustment, the balance sheet shows $400 of supplies as an asset, while the income statement records $200 as an expense for July. Before we proceed to our final example, it's important to clarify a key distinction in accounting. In the previous 5 scenarios, prepaid insurance, prepaid taxes, prepaid rent, prepaid interest, and supplies, these are classified as short-term assets. They typically lose value quickly, usually within a year, so their adjusting entries reduce the asset account directly. We now turn to long-term assets such as buildings, equipment, and machinery. These provide benefits for many years. Instead of reducing the asset account directly, we keep its original cost on the balance sheet and gradually allocate that cost over its useful life. This process is called depreciation, and it's tracked through a contra-asset account known as accumulated depreciation. Let's work through our final scenario together. The company purchased office equipment on March 10th for $12,000. This equipment is expected to last 8 years. Using the straightforward method, we first divide the cost of the asset by its useful life to determine the yearly depreciation. $12,000 divided by 8 years equals $1,500 per year. Next, to find the monthly depreciation, we divide the annual depreciation of $1,500 by 12 months, resulting in $125 per month. Since we are preparing the adjusting entry for March, the depreciation expense for that month is $125. Therefore, we will debit depreciation expense for $125 and credit accumulated depreciation for the same amount. And that brings us to the end of our adjusting entries scenarios. We've now seen how both short-term and long-term assets are handled in accounting. Thank you for watching, and I'll see you in the next lesson. Goodbye.